What's up, guys? Today we're talking about debt to income ratios and VA loans. What does it all mean? How does it impact you? That's what we're covering today. So why is it important for you guys to understand it? Because it is a key metric for a lender to determine if you're eligible to use your VA home loan. Now, there's going to be a couple things to this. One, we're going to talk about debt to income ratios, what they are. We're also going to talk about residual income, and I'm also going to show you guys in the VA handbook where the information lies so you guys can also check for it yourself because some lenders will also have debt to DTI, so debt to income ratio. I'll kind of switch it up to that, otherwise it's long words. Lenders will have overlays where they say, well, the VA for themselves can't surpass a certain debt to income ratio, oftentimes leading veterans to think like they don't qualify for the VA loan. But that is definitely not the case. They primarily look at residual income unless you're on active duty. That's what we see most of the time, that it does cap it at a 55% debt to income ratio. Now, what this the DTI is, it's basically, it's two numbers that are associated with it. One, they look at your gross income, right? So that's before any taxes have come out. They look at the front end ratio, which is going to be what your proposed housing payment's going to be for the new purchase of a property. Then you have the back end ratio, which includes all your debts like credit cards, car loans. If you have child support, alimony that you're paying, they'll also count towards that to also include what the new mortgage is going to be. Now, where there's a lot of misinformation is that the people will say that, well, the VA doesn't want you to exceed a 41% debt to income ratio, and it also faces like harder scrutiny when it comes to lending itself. I don't know where that comes from. Yes, in the VA handbook, it does say anything over 41% debt to income ratio does require 20% increase in residual income. Okay, so I'm going to explain that here in a little bit. So that's why you're fighting kind of two fronts when it comes to this, because you're fighting both a front end ratio and a back end ratio. And it also what determines how you do your approval is if you get what's called an automated approval versus a manual approval. Now, I did a whole video on that because that in itself is going to take 20 minutes to explain what that is. But it's really two ways that your loan gets approved. One may lean more towards, a manual underwrite will lead to more of a debt to income restriction, even though the VA doesn't have one. But most lenders will have some type of additional scrutiny for that, which again, I'm going to show you guys what that looks like. The challenge with debt to income ratios, like I mentioned before, is that it looks at your gross income. So if you're in a state that has maybe higher taxes or you have more taken out of your taxes as well, you're not really factoring what your net income is and what your budget is, right? This is why we always harp on, make sure that you guys are coming up with your budget on a monthly basis. Residual income looks at what your net income is. Another thing that debt to income ratios do not include are things going to be like groceries, your car insurance, and just like your general lifestyle of spending money, right? Lenders primarily care, do you have money in the bank for closing costs or reserves, to kind of depend on what's needed. Most of the time, VA loans don't require any type of additional reserves. But the VA also doesn't factor in its residual income, things like groceries, cell phone bills, things like that, which add up pretty quick, especially if you're paying like for insurance, for like health insurance outside your pay stubs, right? That's going to be another big factor. That's why it's so important for you guys to hone in and sit down and create that schedule for yourself. Now, I'm going to pop over to the VA handbook, and I'm also going to link it down below so you guys can see that. Let me see here. All right, so this is going to be the VA handbook. I'm going to put Control F to find where all the info is that we need. So I'm going to type in residual income, and then it's gonna pull it up right here. All right, so one of the things that I want you guys to think about when you're going through this is that this is kind of where it says that, hey, if a veteran who maintains an excellent credit history, right? This is for residual income. We're going to go over that. has satisfactory payments for shelter expenses, which is like your housing expense, may be approved in spite of shortfall in residual income. It's important to know that because that does require VA approval in order to process that. So that is something that can take extra time to actually qualify you for the loan as well. And another piece is that they do allow for higher debt to income ratios, but again, you do have to have some compensating factors when it comes to that piece. All right, so now let's go over this next part, which is going to be your residual income calculation. So this is kind of the bread and butter of everything that you really need to focus in on. Now, this is for residential incomes by region or loan amounts of basically just shy of 80,000 or below. So we'll kind of skip that one because I really haven't seen, I don't think we've ever done one that's under, just kind of based on where pricing has been. So key things to indicate based on where you're at, Northeast, Midwest, Southwest, in the state that you're in, they're going to assign this residual chart, okay? Now, again, residual is going to be your net income after all your taxes, state taxes, federal, Social Security, Medicare, all that stuff taken out. They're also going to factor in 14 cents per square foot for utility costs. This is why people sometimes get caught off guard when trying to qualify for a VA home loan because the lender doesn't know how to do it. We do them all the time, so we know what we need to look for. The other part that you're going to notice, at least when I look at this, is that these numbers are really low. In a way, it's veterans get themselves in trouble because they don't budget. So lenders are letting them know, like, hey, you can qualify up to this amount of money, thinking like, oh, the VA's got my back, and I can go up to whatever the budget may be that the lender has set for you. Lenders give you they give you a letter saying that, hey, you can go up to buy X amount of dollar property. But what I encourage you to do is to focus on the monthly payment, right? If you have VA disability compensation and you're not going to be property taxes, well, guess what? You may have to pay taxes for now, and then later that's going to fall off. What impact does that have for you in the short term? Remember, home ownership in general is expensive because you still have to maintain that property. If you're renting a property, you're paying a premium because someone else is doing all that work for you. So think of it that way. And when you're paying a mortgage rent, you are paying someone else's mortgage payment. You're just not reaping the benefits of those payments for your taxes or anything else. So those are all things to consider. So like I said, so look, a family of three living in the Midwest, they basically want you to have at least $889. Now, if you need to gross that up by let's say you're over the 41% debt to income ratio for the 20%, you basically have to net $1,066.80. But if you factor in getting groceries these days, car insurance, that money kind of goes real quick. That's why it's so important for you yourself to kind of set that up. And remember, normally a manual underwrite, which I'm going to link the video down below, normally caps out around 50% based on my experience. I've seen regular automated approval loans go 75%. I think it's ridiculous, but you can do it. Everyone's financial picture is different. And if you're buying in a community property state, you really have to be careful because even though, let's say, a spouse is not on the mortgage, but if you're married in a community property state, spouse is not on the mortgage, they still have to pull their credit report and use those liabilities against you to qualify. So that's why in some states you can qualify for a VA loan when you're married and not other states. So those are things that you need to just be on the lookout for when you're going through that process, especially if let's say you're getting out of the military and you're trying to figure out where you want to live. Again, this is why it's so important to do your homework and talk with somebody, which we're happy to help. We've got a link down below. You can schedule a call with us and we can go through that. So please, guys, make sure you guys hit the like and subscribe button. Share the video with other veteran communities because we want to get veterans educated on the home buying process, at least as far in advance as possible. I am a huge fan of that. So I'll catch you guys soon.